Hello, financial freedom seekers. Before we dive into the world of smart investing, hit that subscribe button and give this video a thumbs up. Welcome to a channel built for those who dream big and strive for financial independence. Today, we're unraveling the power of smart investing, a tool so potent it can transform your savings into a fortune. It's not just about money, it's about securing a future where you call the shots. Now, strap in as we embark on a journey to financial independence through smart investing. So, you have savings, great start! But are they working for you? Let's talk about the magic of compound interest. Imagine a snowball rolling down a hill. It starts small, but as it rolls, it picks up more and more snow, growing larger and faster with each turn. This is essentially what compound interest is. It's the process where the interest you earn on your savings begins to earn interest itself. It's your money making more money for you, without you lifting a finger. Let's break this down further. Say you have $100 in your savings account. At the end of the year, your bank gives you a 10% interest, which is $10. So now, you have $110. Now if you leave that money in the bank, next year, you'll get 10% interest. Not just on your initial $100, but also on the $10 you earned as interest. That means you'll earn $11 in interest, bringing your total to $121. This might not seem like a lot at first, but remember our snowball. Just like how it grows over time, so does your wealth. Over years and decades, that initial $100 could grow into thousands, even tens of thousands, thanks to the power of compound interest. So what's the catch? Well, there isn't one really. The key is to start as early as possible. The more time your money has to accumulate interest, the more it can grow. It's why financial advisors often say that the best time to start saving was yesterday, and the second best time is today. Whether you're saving for a new car, a house, or your retirement, compound interest can help you reach your financial goals faster. It's like having a silent partner who's always working to make you richer. Remember, the sooner you start, the more time compound interest has to work its magic. Scene script. Ready to invest? Hold on. Ever heard the saying, don't put all your eggs in one basket? In investing, we call this diversification. Now, what does diversification actually mean? Well, in essence, it's the strategy of spreading your investments among different types of assets to reduce risk. You see, not all investments perform well at the same time. Different sectors, industries, and types of investments can react differently to the same economic event. Let's think about this for a moment. You wouldn't want to put your entire life savings into one single company's stock, would you? What happens if that company goes under? You'd lose everything. But if you spread your investments across a variety of different companies, industries, and even countries, then even if one investment doesn't do well, others might. And that can help to offset potential losses. So how can we diversify? Well, there are several types of investments you can consider. First, there are stocks. These represent ownership in a company and can offer high potential returns, but they also come with higher risk. Then there are bonds, which are essentially loans you make to a company or government in exchange for regular interest payments. They're generally considered lower risk than stocks. Next, we have real estate. This involves investing in physical properties, either through buying and selling or through rental income. Real estate can be a good way to diversify because it's often not correlated with the stock market. Lastly, there are mutual funds. These are investment vehicles that pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. Mutual funds can be a great option for those who want diversification, but don't have the time or expertise to manage their own portfolio. But remember, diversification is not about simply collecting a variety of investments. It's about finding the right balance for your specific goals and risk tolerance. Diversification can help you balance risk and reward. It's a key strategy for smart investing. In the world of investing, patience isn't just a virtue, it's a necessity. Let's talk about the power of long-term investing. You see, the world of investments isn't a sprint, it's a marathon. The benefits of long-term investing are numerous, and one of the most significant is the potential for substantial returns. Just think about it for a second. When you invest in a business, you're essentially becoming a part owner of that business. Over time, as the business grows and prospers, the value of your investment grows too. It's like planting a seed and nurturing it over time. You wouldn't plant a seed today and expect a fully grown tree tomorrow, would you? Similarly, investments need time to grow and mature. Long-term investing also allows you to weather market fluctuations. The stock market is a dynamic entity, constantly moving, constantly changing. There are periods of growth and there are periods of decline. Short-term investors might panic during these periods of decline, selling their investments out of fear. But as a long-term investor, you have the luxury of riding out these temporary dips. You understand that these fluctuations are a normal part of the market cycle. Moreover, long-term investing can lead to compound returns. Remember our discussion about the power of compound interest? Well, the same principle applies here. The longer you hold on to your investments, the more opportunity they have to generate returns. And these returns can then be reinvested, leading to even more returns. It's a snowball effect, and it's one of the most powerful wealth-building tools at your disposal. So the next time you're tempted to sell your investments because of a temporary market dip, remember the power of patience. Remember that you're in this for the long haul. Remember that your investments need time to grow and mature, just like that seed you planted. So when it comes to investing, remember, it's not about timing the market, it's about time in the market. You don't need a fortune to start investing. In fact, regular investing, no matter how small, can lead to big returns. Let's talk about a key strategy employed by savvy investors all around the world: dollar cost averaging. This concept might sound a bit complex, but it's actually quite simple. Dollar cost averaging is investing a fixed amount of money at regular intervals, regardless of the price of the investment. This could be weekly, monthly, or quarterly, depending on your financial situation and comfort level. Now, why is this strategy so effective? Well, it's all about mitigating market risks. You see, when you invest a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high. This can significantly reduce the impact of market volatility on your investment. But the magic of regular investing doesn't stop there. It also leverages the power of compound interest, which we discussed earlier. By regularly adding to your investment, you're not just growing your capital, you're also growing the interest that capital generates. Over time, this can lead to exponential growth of your investment. Some might argue that waiting for the perfect market conditions to invest can yield higher returns. But let's be honest, predicting the market is a gamble at best. Regular investing takes the guesswork out of the equation and puts the power back in your hands. Think of it like planting a tree. A tree doesn't grow overnight. It requires regular watering and care, and over time it grows into something big and strong. Similarly, your investment needs regular contributions to grow, so don't get caught up in the myth that you need a large sum of money to start investing. A small seed can grow into a mighty tree, and a small regular investment can grow into a substantial fortune. Remember, the journey to financial freedom is not a sprint, it's a marathon. And regular investing is like setting a steady pace for that marathon. So start small if you must, but start. Regular investing is a powerful tool in your financial freedom toolbox. All right, we've covered a lot of ground today. Let's quickly recap the key points we've discussed. First, we delved into the magic of compound interest, the secret ingredient to growing your wealth exponentially over time. Remember, the earlier you start, the more time your money has to grow. The power of compound interest is like a snowball rolling downhill. It starts small, but as it rolls, it gathers more snow, becoming larger and faster. Next, we underscored the importance of diversification. It's essential to spread your investments across various asset classes to manage risk and maximize potential returns. Just as the saying goes, don't put all your eggs in one basket. Diversification is your insurance against the unpredictable nature of the market. Then we explored the virtue of patience in investing. It's not about timing the market, but rather time in the market that matters. Long-term investing allows you to ride out market volatility and benefit from the overall upward trend of the market. Finally, we talked about regular investing. It's all about consistency. Regular contributions, no matter how small, can accumulate into a significant amount over time. Remember, smart investing is about making your money work for you. It's your ticket to financial freedom. Until next time, keep investing smartly.